Welcome to the first episode of The Big Picture. Today we talk about tariff, trades, globalization and impact on global growth. So over the last 30 years, the phenomena that we saw was globalized manufacturing and globalized delivery of services, where every country chose what they were good at. China became one of the best manufacturing nations in terms of cost, and India became software and technology powerhouse of the world in terms of services. So today, with all this noise that we hear about, US imposing tariff and countermeasures from other nations, we are at a point where this globalization, the phenomena of globalization, could kind of reverse, and everything could become, we may end up living in a deglobalized world, or something which is more localized, or where every country looks for its own interests. So in a globalized world, what we saw was India was able to provide low cost software engineers. China is able to provide low cost manufacturing, which kind of helped the world to be more prosperous, in the sense that there was a huge wealth effect both in the west and in the east and in the middle region, and this is what is getting dismantled. So some of the positive effects that we saw over the last 30-35 years will get reversed. Now it leads us to a lot of questions. So what are those questions? And those questions we don't really have answers to today. So what are those questions? So to what extent we will see this deglobalization? To what extent supply chain will be localized? To what extent US will come back in manufacturing? To what extent the world, which has been practically holding its foreign currency reserves in US dollar, will move away from that? So these are all the unknowns that we are faced with today. So what did we do in the last 30 years? As an investor, most of our investing was centered around a view on US dollar from a big picture macro perspective. So one has to take a view on where we are on the US dollar cycle. US dollar has every currency has its own cycles, and US dollar is not immune to that. So now what we see is that will not be sufficient. So the commentaries that we read, the research that we read today points out to a situation where US dollar is likely to lose its dominance, and this will have significant implication for investors. So what should investors do? Very clearly, what we did over the last 30 years is not what we should be doing in the next 30 years or next 10 years. So we are at an inflection point here where we are looking at factors beyond US dollars that will drive our investment decisions. So if you are an US investor, let's say you are an US NRI, you are a non-resident Indian living in the US, where most of your assets are US dollar denominated, you might be better off by diversifying it into other currencies, because we don't know what shape this trade war is going to take over a period of time, which countries are going to gain prominence. India will probably gain, provided we are able to get our manufacturing mojo back. We will be one of those countries to watch out for. So if you are an US NRI specifically, where most of your assets are in US dollar, you should be looking at diversifying away. It could be when US is starting its US impose this tariffs and counter tariffs, and every country is negotiating for itself. Even Europe might actually make a comeback. Japan is already making a comeback. India is promising a comeback, and so even this should be reflected in your portfolios. Your portfolios cannot be solely largely driven by investments in US technology companies or US companies. A move towards a global portfolio is probably the need for the hour. We'll come back to you next week with another episode of Big Picture. Till then, thank you.